Hello everyone. So today we are going to see the continuation of ratio analysis, that is nothing but the different types of ratios. So in the earlier video you already learned what is a ratio and what is the purpose of doing financial ratios and financial statement analysis. So now we are going to see the different types of ratios which is used in the financial statement analysis, which we can basically classify into 4 categories: profitability ratios, liquidity ratios, leverage and efficiency ratios. So we will see one by one. So the first one is profitability ratios. So the name itself indicates that what it is doing. So when you are looking into the financial statements of a company, it will give you how much is your net profit or gross profit. But the thing is, in that operating expenses will be there, operating incomes will be there, and non-operating expenses will be there, non-operating incomes will be there. So you have to sort out all this and you have to find out like what is your gross profit ratio or what is your net profit ratio, what is your return on the assets, or what is your operating profit alone. All these things can be calculated by using this profitability ratios. So this is basically telling you how well your company is running and what is the type of income it is generating to you. So here we are basically using these equations to calculate gross profit ratio, which is showing the relationship of your gross profit towards sales, because sales is the major source of income for a company. So which will show how the sales is connected to your gross profit. The next important ratio under this category is net profit ratio, which will tell you what is the exact net profit for a financial year and how it is connected to your turnover or the sales during that year. And next, all this gross profit or the net profit includes your non-operating incomes as well as non-operating expenses during the financial year. So you just wanted to know only like what is the operating profit. I don't want to see the non-operating items which is included in my financial statements. Means that is also possible by using operating profit ratio. You can connect your operating profit along with your sales. Now there is a question, like most of the students will be confused by looking into the financial statements, what is a operating profit and what is a non-operating profit. So say for example, I am doing a business and I also did some investment in shares and I am receiving some interest on that investment or some income from that investment, or I could say I have opened a savings account and I am receiving some interest from that savings account. So that interest which I received is a credit side item or an income, but when I am taking my operating profit, that interest which I generated will not be treated as an operating profit because it is my non-business income. I have invested money in the savings bank account and they have given me interest. That doesn't mean that I received that income from my business. So operating profit includes only those income which is connected to my operating activities or pure business activities. Other than that, whatever is coming will be excluded under this. And you can also see if you invest some money on the assets, what is the return you are receiving. This can be calculated by applying the return on assets equation. Same manner, you will be investing money in the equity and there also what is the income you are generating by investing money in the equity. That is also you can calculate here. So the profitability ratios will help you to identify what is the nature of your profit and how well the company is generating income from different sources. And next we have very important or very easy ratios, I could say, which is called as liquidity ratios. We will also call it as quick ratios. Why we are using the term quick means like it is, these ratios are connected to your current items, current assets, we could say. So here we have basically 3 ratios: current ratios, quick ratios and cash ratios. So we know that when we are looking into the financial statements like balance sheet, like we could see different types of assets will be there. So in that we are going to pick all the current assets, and from the liability side you are going to pick the current liabilities. So what is the speciality of this current items, current assets and current liabilities means it will be remaining in your organization only for a short period of time. Since we are using it only for a short period of time, we will call it as current items or the current assets or current liabilities. So I could say one example, like two assets I am picking from the balance sheet. One is stock, another one is land and building. So which item I can easily sell in the market? Like I can sell the stock in the market and I can easily convert the stock into cash. But if I am trying to sell my land and building, even though I can raise more funds there, it takes a longer period of time. So that is called as my fixed assets. So all liquidity ratios are related to the current assets as well as the current liabilities, and it is showing the liquidity position of the company, how good your company is to convert the assets into cash. What is your liquidity position? Of course, to run the business we need fixed assets as well as the current assets, because we need money to meet the day-to-day expenses. So this ratio will tell you the current ratio, quick ratio and cash ratio, and these are the equations which we are applying under different scenarios. Next, we have very interesting ratio which is called as leverage ratios or solvency ratios. So what is this leverage or solvency ratio telling? Means we have different types of financial obligations. So how well your company is to meet this financial obligations, that can be identified by applying this leverage ratios or the solvency ratios. So we have different types of equations for calculating these solvency ratios. Some are related to your debt and assets, and you know what is debt and assets. And another one, like you are considering your total debt from the financial statements as well as the total of your asset side. It is including both your current and fixed assets. And next is related to your debt as well as your capital. The next ratio is related to the shareholders fund only. It is not including your debt as your denominator. So you can see the ratio how it is coming by looking into the equation. Next is the financial leverage, which is connecting the total assets as well as the shareholders fund. So basically the solvency or leverage ratio can be calculated by using all these equations, and the purpose of using this leverage or solvency ratio is to see how the organization is meeting its different types of debts or the financial obligations. So next is, like, we have the last one ratio which is showing the efficiency of the organization. So when we speak about the efficiency, we used to think about how well your management in doing the business, or how they are organizing things or planning or implementing the decision, all these things. Same manner, like we are investing a lot of money in the assets, especially the fixed assets or long-term assets. So when I am investing money, what is the return I am getting? Whether my investment plan was a good decision or what, like that, so many questions arises. So here we have different types of ratios, like asset turnover ratio, inventory turnover ratio, receivables turnover ratio, as well as the payables turnover ratio. So when I talk about the assets turnover ratio, it is connecting my total assets values with the sales value or the turnover value with the financial period. And the inventory turnover ratio is connecting the cost of goods sold with my inventory. Inventory is nothing but my stock for the particular period of time. The other two receivables ratios are bills receivables as well as bills payables. That means which is related to your credit sales as well as the credit purchases. How many days of credit period you are getting from your supplier, and how many days credit period you are giving to your customer. So when the sales or purchases happening in the mode of credit, like we will be receiving a period of settling the amount or the money, so that can be easily identified in case of credit sales as well as credit purchases by using this receivable turnover ratios. So I hope you all understood the basic concepts and how to calculate different ratios by using different equations by listening to this video. Thank you so much for listening.